Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. A critical Fed week looms, but markets are eerily calm. With layoff numbers surging, is this the lull before a major storm triggers a correction and shatters investor complacency? Second, iPhone makers pivot shocks Wall Street. AI server revenue skyrockets 26%, dethroning the iPhone. The AI gold rush isn't just about chips. We reveal the new unexpected king of the hardware boom and where the smart money is now flowing. Finally, New York Times vs Perplexity AI. The copyright war ignites, threatening a data inflation crisis. This isn't just a lawsuit, it's a high-stakes play to create a multi-billion-dollar AI put option. Could this battle re-rate the entire media industry overnight? Warning, the market is on edge as we head into a critical week. With the Federal Reserve poised to cut rates at an 87% probability, the stakes are high and the impact could be monumental. I'm telling you, the Nasdaq's 0.3% rise to 23,578.13 is just the calm before a potential storm. Markets are bracing for a pivotal December 10 FOMC meeting, where a rate cut seems almost certain, but watch out, internal Fed divisions could throw us a curveball. Why does this matter? Listen to me. The market's fixation on the Fed's next move is justified. September's PCE inflation report showed a 2.8% year-over-year increase, lining up with expectations. But here's the kicker. Consumer sentiment is improving, yet labour market data is flashing warning signs. Job creation is down significantly from last year, and the Challenger report shows a 54% surge in layoffs. Investors are left navigating between the optimism of rate cuts and the harsh reality of economic headwinds. Let's dive into the layers of this market puzzle. First, the policy layer. With core inflation at 2.8%, the Fed's decision is almost locked in. Yet, the internal debate is fierce, with some officials pushing for even deeper cuts. If the Fed surprises with a hawkish tone on December 10, we could see tech-heavy indices like the Nasdaq face a sharp 10 to 15% correction. The VIX at 15.78 suggests complacency, but don't be fooled, this is the kind of lull before the storm that catches unprepared investors off guard. On the money flow layer, capital is cautiously rotating. The Dow's resilience, closing up 0.2% at 47,954.99, masks an underlying shift towards value sectors like financials and industrials. These sectors are positioning for stability as net interest margins expand with stable rates. If the Fed delivers the expected cut, watch for a rally in financials, but if they hold steady, brace for a wave of repositioning. Finally, the valuation layer. Tech stocks are under pressure. With high duration names like Netflix down 2.9% despite strategic acquisitions, the sector's vulnerability is exposed. Mega cap tech concentration is high, and any hawkish signals from the Fed could trigger a valuation reset. I'm telling you, it's time to recalibrate portfolios, trim high P, divided by E-tech stocks, and pivot towards sectors poised to benefit from stable rates like financials and industrials. Sector-wise, retail and AI software are today's standouts. Salesforce jumped 5.3% on explosive AI adoption news, while Alta surged 12.7% after robust earnings. These are the plays showing resilience amid consumer pressure. In contrast, Netflix's acquisition gamble is a cautionary tale of execution risk. The market skepticism is reflected in its stock performance, and regulatory hurdles loom large. Good advice makes you rich. Bad advice costs you a fortune. Listen to me, act now. Short term, hedge your tech exposure as the Fed meeting approaches. If rate cut expectations falter, tech could tumble. Medium term, overweight financials aim for a 3 to 5% increase in your portfolio allocation to XLF or individual bank stocks like JP Morgan. The stable rate environment is ripe for expanding net interest margins. For defensive strategy, hedge with SPY or QQQ puts targeting a 2% portfolio allocation. If the Fed surprises the market, these hedges will pay off. Remember, time's running out. Next week's FOMC meeting is the key event. Watch for Powell's language on future rate cuts. It's your signal. If he hints at caution for 2026, prepare for volatility. Keep an eye on the Nasdaq support level at 23,500. Breach it, and it's an escape signal. Let's dig into today's most important developments and prepare for the week ahead. The clock is ticking and the market's poised for action. Follow this framework and you won't lose. Now, let's examine today's key news stories and their implications. A key partner to Nvidia just posted a staggering 26% year-on-year revenue spike for November, fueled by one thing: the global race for AI. We previously analysed how the AI capital expenditure supercycle was shifting from theory to hard orders. This print is a fresh, concrete data point. Now, get this. This surge isn't just a temporary blip. It signals the start of a massive, sustained AI hardware supercycle. And actually, this is fundamentally different from the usual ups and downs of the consumer electronics market, like smartphones. This is about a long-term capital expenditure boom where the world's biggest companies are pouring money into building the foundational infrastructure for AI. A while back, we also flagged the goods reinflation channel think components and power showing up in producer prices. Foxconn's numbers are what it looks like when that demand hits the build-out layer. This new spending cycle is so powerful it could even offset economic weakness in other sectors. We're talking about Foxconn, of course, the world's largest electronics manufacturer, better known for assembling Apple's iPhones. But the game is clearly changing. The company pulled in a massive $27 billion in a single month, driven by what it calls strong momentum for AI server racks. Continuing our last discussion on supply chain stress, remember how Nvidia's pivot toward mobile-class LPDDR memory blurred the lines between data centers and smartphones? Foxconn sits at the intersection where those component battles turn into finished racks. For years, Foxconn's fate was tied to the iPhone, but that dependency is over. The company has, believe it or not, successfully pivoted. Recent data shows its cloud and networking division, which includes these AI servers, now accounts for 41% of its total revenue. That has officially surpassed its consumer electronics segment, including iPhones, at 35%. This isn't a side hustle, it's now their core business. As we've discussed before, that's the escape hatch from handset cyclicality into infrastructure scale demand. And this goes beyond just building hardware for Nvidia. The AI power players are lining up. Just last month, OpenAI, the creator of ChatGPT, announced it's collaborating directly with Foxconn to design and manufacture its next-generation AI hardware. We previously noted the Wall Street debate over circular financing in AI chip makers investing in their biggest customers and vice versa, but today's update shows that regardless of those capital flows, the downstream manufacturers assembling the gear are capturing real operational demand. Interestingly enough, this also points to a major shift in the global supply chain. This collaboration isn't just about building servers, it's about building them closer to home. It's part of a larger trend accelerated by policies like the US CHIPS and Science Act to move the manufacturing of critical technology out of Asia and into North America. Foxconn is already investing hundreds of millions in Wisconsin and Mexico to build AI server factories. As we've been tracking, the bottlenecks aren't only chips, they're also grid capacity and logistics. Localizing production while upgrading power infrastructure is how Western AI leaders aim to build resilience, even if it means higher costs. This isn't just a pivot, it's a strategic coup. Foxconn has quietly positioned itself as an indispensable player in the AI infrastructure build-out. So the thing is, you have to follow where the profits are flowing in this AI gold rush. For a long time, the assumption was the big money was only for chip designers like Nvidia or the software creators, but that's changing. Foxconn's recent 17% jump in net profit, driven almost entirely by its AI server business, shows that huge value is now being captured by the specialized manufacturers who actually assemble the hardware. As we highlighted a while back, component price spikes, especially in memory, where those 30% plus jumps started showing up, are reshaping the bill of materials, and with it, who gets paid? Wall Street is reacting with force. While the company is famous for its work with Apple, its deep move into AI has sent its stock on a tear, following a 76% surge over the previous 12 months. We've also cautioned that if the circular financing concerns in AI get tested, capital expenditure could wobble, but for now, prints like November's are reinforcing the infrastructure thesis. This isn't just about a good quarter. It's about a fundamental shift in the tech supply chain. The company that builds your phone is now building the backbone of artificial intelligence. The November report confirms it. While the world is focused on the AI software race, the battle to build the physical foundation for that race is creating massive financial winners, and Foxconn is now firmly at the center of the action. And as we mentioned before, that physical race stretches from memory to power, exactly where the constraints have been tightening. Looking ahead, a couple of things are worth watching. First is whether this capital expenditure cycle in AI continues to accelerate, as it could be a major driver for the tech sector and even the broader economy. Also keep an eye on the telltales we've been tracking: utility and grid, capital expenditure announcements, memory price prints and LPDDR lead times, whether the big clouds shorten server depreciation schedules, and the gap between reported profits and free cash flow at the major spenders. The second focal point is the rise of sovereign AI. This is the idea that nations themselves, not just companies, need to control their own AI infrastructure for national security and economic competitiveness. As we flagged earlier, that demand can amplify regional power constraints, pushing even more investment into data centers and into the manufacturers supplying them. All market data is subject to change. This report is for informational purposes only and does not constitute investment advice. So while the companies building the physical hardware for AI are posting incredible numbers, the story on the software side is, well, a lot more complicated. That brings us to the New York Times, which has just filed a lawsuit against AI startup Perplexity, alleging the company illegally copied and distributed its copyrighted content. This isn't just a legal letter, it's a direct shot fired in the war between legacy media and the artificial intelligence boom. The situation presents a fascinating legal duality. At its core is the concept of fair use, which allows limited use of copyrighted material if it's transformative. The New York Times argues Perplexity's summaries fail this test. What really brought this to a head was a recent Supreme Court ruling in a case involving Andy Warhol's art, which has already tightened the definition of transformative, making it harder for commercial users to qualify as fair use. So this lawsuit is really testing the breaking point of that doctrine in the age of AI. And believe it or not, this isn't an isolated incident. The Chicago Tribune filed a nearly identical copyright lawsuit against Perplexity just one day prior. The battle lines are being drawn, and the target is a 2-year-old startup backed by over $1.5 billion in funding from investors, including NVIDIA. However, if you zoom out, you'll see another layer of strategy at play. This wave of litigation is creating a new hidden expense for the entire AI industry, which researchers are calling the cost of data inflation. Every lawsuit, every settlement, and every future licensing deal adds to the operational cost of building these AI models. A while back, we analysed how Warner Music's settlement and partnership with an AI music startup could usher in walled gardens, where exclusive licensed catalogs sit behind specific tech platforms. The latest media lawsuits are pulling text-based AI in the same direction, away from free scraping and toward paid exclusive data pipes. This directly threatens the profit margins of companies like Perplexity and could slow down innovation while giving a huge advantage to vertically integrated giants who own their own massive datasets. The lawsuit accuses Perplexity of unlawfully scraping the Times stories, videos, and podcasts. But Perplexity is firing back with a confident statement from their head of communication. Publishers have been suing new tech companies for 100 years, starting with radio, TV, the internet, social media, and now AI. Fortunately, it's never worked, or we'd all be talking about this by telegraph. That statement, however, misses a crucial part of the bigger picture. When we place the West's legal battles alongside China's AI development strategy, a potential arbitrage becomes clear. As legal fights drive up data costs in the US, and Europe, Chinese players operating under a different regime could advance faster. For our audience in the Chinese-speaking world, this is particularly relevant. China has its own regulations managed by the Cyberspace Administration of China, which require firms to respect IP but also foster rapid development. If Western AI companies get bogged down in expensive legal fights, it could allow Chinese AI companies to develop their models more cheaply and quickly. This is where the situation takes a more complex turn. That confident claim that it never worked is now facing a massive $1.5 billion counter-argument. That's the record-breaking amount the AI startup Anthropic recently agreed to pay to settle a copyright lawsuit from a group of authors. So what's the real endgame here for publishers like the New York Times? It seems to be more ambitious than just stopping copyright infringement. Some analysts believe they are trying to create what's being called an AI put option. Essentially, if these lawsuits succeed, they could establish that vast media archives are an essential high-value input for the AI industry. This would force AI companies into paying massive licensing fees, creating a brand new high-margin revenue stream for publishers. We previously analysed how, in music, exclusive licensed data could harden into high walled gardens. Apply that logic to news, and you get gated archives powering proprietary AI models. It could fundamentally re-rate the valuation of these media companies, turning their content libraries into gold mines. The New York Times is already in an ongoing copyright suit against Microsoft and OpenAI. This new lawsuit against Perplexity opens another front in what is becoming a full-scale campaign by publishers to protect their intellectual property. With a $1 billion settlement already setting a precedent, this isn't just a legal skirmish. It's a high-stakes showdown that could define the value of content in the age of AI. So the key takeaway here is to watch if the market starts pricing in a data sourcing risk premium for AI companies. This means investors will look more closely at how an AI company gets its data. Are they scraping it from the web, or are they signing explicit licensing deals? Expect more exclusive content partnerships, yes. Those same walled gardens we talked about in music to pop up across news and other media. This creates a new competitive moat based not just on how good a model is, but on whether its data supply chain is legal and ethical. And as we noted when comparing US licensing dynamics with China's more top-down framework, whichever model sets the global standard will shape the flow of royalties and the balance of power in the creative economy. The focal point, after all, is no longer just the technology, but the legal and ethical foundation it's built on. All market data is subject to change. This report is for informational purposes only and does not constitute investment advice.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.